Good day, fellow investors. ADM stock recently crashed, and many of you asked me to give you an update on what I think, whether this is an opportunity or not. And as you will see in this video, yes, ADM is now a much better buy than it was 3 days ago. And I've been following ADM for more than 5 years. It was also a covered stock on my research platform. I will now start covering it again to see whether it is a real value investment over time. So let's start with the news, bad news, Securities Exchange Commission probe, accounting. We don't know yet about what, but that is enough for the market to panic and send the stock down. The CFO has been laid off of the nutrition segment. The earnings per share are guided to be lower than expected by approximately 40 cents. Not much, still to be in profit for the year, but all the analysts downgraded ADM stock from the previous target of 96 straight down to 61, Goldman Sachs from 90 straight down to 67 on the latest developments, as it could cloud ADM's near-term and medium-term investment case. Also here from 98 to 66, and that's what analysts usually do when a stock is down, they downgrade it. However, this nutrition unit that is the issue in this case produces 10% of ADM's profits and even less of revenue. And there is also the issue that the profits of the nutrition segment haven't been as expected due to the acquisitions. And typically, as analysts do, this is from BMO, we would expect ADM to reassess strategic priorities within nutrition as the new profitability run rate becomes more clear. Now the profitability run rate for nutrition part, 10% of the business, is not clear. But that is enough for all of them to slash their targets by 50% for what is at best 10% of the business. That is Wall Street. And now let's discuss the business overview so that you can fit how the nutrition fits into the business, see the whole picture of the business to make a valuation, and then see how the risk and reward of this great business over time fits your portfolio. So it is a food processing business, 750 facilities, 300 food and feed processing locations, 440 crop procurement locations. They buy the crops, do whatever is necessary to process them, and then sell them forward to your food producers, etc. Their strategic targets is single-digit growth ahead. This was also a target to reach 1.5 billion in operating profits from nutrition. This will likely be adjusted over time, so we have to think when it comes to the run rate going forward, but they are investing, they are planning on repurchases on the capital, and they are doing a lot of acquisitions like wild 3 billion of ingredients to create that infrastructure of food where customers can get everything they need from one company. They have a pretty large footprint. This is from agricultural services and oil seeds, and that business makes a lot of profit last year, will do also good this year, but on average I think that this business makes around 2 billion in operating profits. And if we look further at carbohydrate solutions, that business makes around 1 billion of operating profits. It is food, so it goes up and down. 2 billion plus 1 billion is 3 billion. Then we have nutrition, and this is the issue now, but they did a lot of acquisitions, tried to grow this adjunctive part of their business. We'll see how it will work out, but nutrition has also been growing in revenue. This is 7% of revenue, don't forget, and a little bit also in profits. Perhaps this will be lower, perhaps it will just get to an average of around not 1.5 billion, but maybe 500 million for the medium term. But anyway, you can see here nutrition's revenue is just a small part of ADM's revenue. Let's see how this fits the financials. As I said, food, bad years, better, bad, and then great, and then we should go again to bad. So these profits are exceptional and we should adjust for a normal run rate. And even if you look at their targets, if you check here on the note, you see that their base earnings normalized are of 4.5 per share. So on that base, they expect growth going forward. So I say 4, maybe $5 per share going forward on average, and growing on that is what you should expect. To keep in mind that also the corporate side has significant costs there, which is also a detractor. So I think that on average, if we look to profits, we get to 2 billion. The balance sheet is strong, so they have debt, but that debt is there to cover the inventory, where the food they buy, then process it and then sell it to you when you need it, because you want to buy your bread every day, while the food on the fields doesn't grow like that. It grows once or twice per year. So that is their business. The book value here is 43. The stock price is getting closer to that. There are also investments like Wilmar, which is a covered stock on my research platform. And there is some goodwill, 6.3 billion, that will likely be impaired a little bit given the acquisitions in the nutrition segment. But okay, all in all, the company has created 24.6 billion in retained earnings, which is the value of the company now. Thus, they created that value over time. Cash from operations before working capital changes, you can see here the ups and downs from operations minus corporate. I think the going forward run rate will likely be 2 billion. They are investing around $1 billion to keep things as those are. They are investing in growth. They just did another crop acquisition that the market didn't like, as it pushed down the stock 4.7% in December based on that acquisition. However, they are doing what they are doing, growing the dividend already for 50 years. There are some share repurchases. Okay, I don't like this where the stock price was high, and here nothing where the stock price was low, but maybe they will remedy for that. Now let's check the valuation. When it comes to valuing cyclicals, you have to understand it. Bad times, bad times, good, bad, great times, and likely will be followed by a little bit of bad times. So we have to understand that average over time. Value creation, if they make 2 billion of value, that's 7.4% on the current market capitalization. If they grow 4%, 2% inflation, 2% business growth, that's an 11% long-term return, which is not bad. Of those 11%, you get, 3.5, 4% dividend per share, some repurchases, and now you have to see how this risk and reward fits your portfolio. I personally, as said, will put this on a covered stock, but I want bad, really bad times, not just a scandal. If now we have slowing down food prices, a recession here and there, a market sale or something, this could go a little bit lower. Let's say that in a bad year, they don't make 2 billion, they make 1.5 times a P ratio of 10 to 15, I get to 20 billion, which is not far, but a little bit lower than the current situation. And then I will check it again and see whether it is a buy for me. But for now, Wall Street Analyst gave you a gift if you're looking for a long-term strong business. Food prices, this might push it lower for a while. Food prices have been declining since the peak in 2020 when they made a lot of money, and if it normalizes a little bit, then they go back to the 1.5, 2 billion, but that's normal with food. Over the long term, you see inflation giving it a push, but there are good times, bad times, good times, bad times, great times. This is normal, and these cycles are there, but the key is that without farming, you would be hungry, naked, and sober. So see how this fits your portfolio. It's a business that I know very well. It's a good business. It's an essential business. So very hard that something will replace the infrastructure they have. There is some competition. So there is the volatility in the cycles depending on the year, on the prices, on the margins, but over time they have been growing, acquiring. Of course, in such big companies there will always be some issues, but you have to see how at this, where I would say it's a good business at a fair price, how that fits your portfolio. Me personally, I now have things that offer much more than 11% returns, I think, in my portfolio. So I would need it lower to consider it for my portfolio. Thanks for watching. I'll see you in the next video.